So we're all aware that a mortgage is a loan to buy a house. Namely, it's your principal residence, which is the main house you'll be living in. But how much do you really know about mortgages? Hi, I'm Sandy from eXp Realty, Honolulu, and I've been helping many people buy and sell homes here in Hawaii. But I've noticed that not too many people understand how a mortgage really works. So in this short video, I'll be explaining the basic components of the mortgage and the different types of mortgages out there. If you're going to buy a house, it's really important that you understand how a mortgage works. The more knowledge you have, the better prepared you are. So let's get right into it. It's first important to know the different parts of a mortgage. So a mortgage payment you make every month consists of these following fees. Number one is the principal. This is the total amount of money you borrow from any loan institution. Number two is the interest. This is the amount that the bank or lending institution charges you when you borrow the money over a certain period of time. The interest rate is going to vary depending on your credit score. Number three is the tax. In this case, it's the property tax you'll be paying for the property every year. And number four is the insurance cost. This is the insurance for the home to protect the house against any damages, and also your mortgage insurance in case you put less than 20% down on your down payment. So when you go get a mortgage, what happens is your lender would determine how much you can borrow based on your income, your credit score, your down payment, and other factors. He or she will then provide you with an amortization schedule, which is a table that shows you all the payments that you'll be making over the course of the loan. This table shows you how much you will be paying for the principal and interest portion each month. Well, now that we understand what goes into a mortgage, let's look at the different types of mortgages out there. The first type is the fixed rate mortgage. In this type of loan, the interest rate does not change for the entire life of the loan, for example, over 30 or 15 years. Number two is the adjustable rate mortgage. This is where the interest rate is fixed for a certain period in the beginning and will change in the future. Number three is an FHA loan. An FHA loan is insured by the Federal Housing Administration and only requires 3% down payment. This particular loan requires a lower credit score, but you will be paying a private mortgage insurance, PMI. Number four, there's also a VA loan for those in the military services. This loan is insured by the Department of Veterans Affairs. There's no down payment required for this loan, but you will have to pay a VA funding fee. Number five, finally, there is the USDA loan, which is backed by the Department of Agriculture. There's no down payment with this type of loan, and you can use it with a relatively low credit score, but you are limited to certain areas on the island where you can use this type of loan. So if you're looking into purchasing a home, the best thing you can do before you go get a mortgage is to know your credit score. Since the credit score is one of the most important factors in determining your interest rate, it's best to know what your score might be and if there are any errors in your credit score. Also, shop around for the best loan deal. Different institutions may offer you different loan rates and terms. Don't just go to one bank or lender and consider that to be your only choice. Also, if you're a first-time buyer, make sure you ask the loan officer about the different first-time buyer programs that you might be eligible for. Not all the lenders will tell you about these programs, so you need to make sure you ask. And lastly, I'd like to talk about some mortgage myths that are still out there. For example, there's a myth that you need to put 20% down to buy a house. And as I have explained here in this video, there are so many different types of loans out there that requires less than 20% down. So don't get caught up in this myth and miss your chance of buying your dream home. And lastly, myth number two is believing that getting pre-qualified for a mortgage means that you've been approved for that amount. Your lender is going to have to do some serious work in determining how much you can borrow to buy your home. This takes some time to do. So a pre-qualification is simply means that the lender his initial suggestion of how much you can borrow. Until you are pre-approved or approved for a loan, the amount could change. So make sure you communicate with your lender and know where you stand. Thanks for watching this video, and if you haven't done so already, please hit the like and subscribe button so you don't miss any more videos in the future.